Hello everyone, Steve Ribble with Guardian Accounting Group. Well, they passed it, so now we've got to talk about it. I'm talking about the one big beautiful bill that was signed into law on July 4th of this year by President Trump. One of the key components of this bill is it's making permanent the Tax Cut and Jobs Act of 2017. All of those tax provisions are now made permanent. They were set to expire at the end of this year. So things like lower tax brackets, number one, but also I know small businesses have been concerned about that Section 199A, QBI income deduction is permanent. So you're going to continue to see up to a 20% reduction in your taxable income off of your qualified business income. But let's jump into 10 areas that we're going to see changes going into 2025's tax filing season. And some of these are temporary. The provisions will be in place for only a few years, and some of them are going to be permanent. So first of all, we're going to see the standard deductions increase. So for single filers, you're going to jump from $15,000 standard deduction to $15,750. For joint filers, that increases from $30,000 up to $31,500. Estates and gift tax exemptions are increasing. Those are going to increase for single filers from $13.99 million up to $15 million. And for joint filers, it increases from $27.98 million up to $30 million. The state and local tax deduction is increasing. The Tax Cut and Jobs Act of 2017 put a cap on that at $10,000. That is now at $40,000, and it's going to be indexed 1% yearly through 2029, but then in 2030 it is scheduled to go back to that cap of $10,000. So that one's going to be a temporary increase. SALT tax deductions, if you're not familiar with that, that's your state and local taxes, and it also is your real estate taxes. So all of those combined, you can now deduct up to $40,000 for 2025, which I know my clients and friends and colleagues in the higher income tax states like New York, New Jersey, California, Illinois, they're going to reap the benefits of that deduction there. The child tax credit is increasing. This is a permanent increase. It's going to be increasing to $2,200 starting in 2025, and then it gets indexed for inflation starting in 2026. This credit is available for children that are under the age of 17, and it's also about $1,700 of this credit is refundable. So for parents that perhaps don't have tax liabilities, they can still get some dollars back into their pockets for the refundable credit. The seniors weren't left out in this bill. Seniors age 65 and older are getting a $6,000 per eligible taxpayer increase in the deductions on their tax returns. This is available whether they are itemizing or taking the standard deduction, and phase outs will start at $75,000 for single filers and $150,000 for married filers. What this equates to is an $8,000 deduction for a single filer and $15,200 deduction for joint filers, for husband-wife filers. Some other key changes. Car loan interest is now going to be deductible. Up to $10,000 of car loan interest is going to be deductible, but there's some catches. It's got to be a new car, meaning that you purchase a brand new vehicle, so used vehicles will not qualify for this. And it has to be manufactured in the United States, which is another key provision there. This is a temporary cut. It's only available from 2025 through 2028, and then it goes away. There are phase outs, $100,000 for single filers and $200,000 for joint filers. I don't anticipate this to be a very large deduction for taxpayers, as the average, according to AAA, the average interest paid on new car loans in 2024 was about $1,300. So I don't anticipate it to be a huge deduction for taxpayers, but it is out there. It is something to keep in mind and not to forget about. I know a lot of questions have been coming in on this one. No tax on tips. That's in this bill. It's going to be on the first $25,000 of income, and no taxes on that. It's going to have to be on a W-2 and show up on the W-2s. This is a temporary provision. It's only available from 2025 through 2028, and it is not available for single filers if your income is over $150,000 or joint filers over $300,000. You won't qualify for this. no tax on overtime pay. That's another provision in this bill. That's going to be available $12,500 for single filers and $25,000 for joint filers. It's also temporary, 2025 through 2028, and you do have phase-outs starting at $150,000 for single filers and $300,000 for joint filers. There is a charity tax deduction, which I'm happy to see because I think this is going to be a great benefit for the charities out there. So you can take an above-line deduction. So whether you take the standard deduction or you itemize, you can actually take this. It's a $1,000 deduction for single filers, up to $2,000 for married, and this is a permanent provision in this bill. So that means that if you take the standard deduction, historically people that took the standard deduction, if they donated to charity, they really couldn't take the extra deduction for the charity stuff because they didn't itemize. That's not going to be the case with this bill. So even if you're taking the standard deduction, that's available. So something to keep in mind of going into next year's tax filing season. And then let's talk about some of the bad stuff of the bill. EV and clean energy tax credits are ending. For the car credit, $7,500 tax credit to individuals. $7,500 tax credit for individuals is going to be eliminated in September 30th of 2025. So if you're thinking about buying a new EV and it qualifies for that credit, you're going to want to do that before the end of the third quarter. Otherwise, you won't get the credit. The $4,000 for used EVs also expires in September of this year. For solar credits or energy credits for solar, electric heat pumps, energy efficient doors and windows, those are all going to expire at the end of 2025. So December 31st of this year, if you're thinking about this and it makes sense for you, you want to make sure you put that in place so you can take advantage of the existing tax credits before they expire in December. And the last thing that we'll talk about is these quote-unquote Trump accounts. These are for the kids. This is going to be a short time frame, so 2025 through 2028. The government, for kids born in those years, is going to deposit $1,000 into the Trump accounts for the children. Parents can also contribute up to $5,000 per child, and employers, you can actually contribute up to $2,500 per employee, and it's not added to taxable income, so it can be a benefit for the employees out there. These are going to grow in tax deferred accounts, and as long as the withdrawals are for qualified withdrawals, they're going to be taxed at long-term capital gains rates. And the investment is going to be a diversified U.S. stock index fund. So it's something that is there for taxpayers, and something that hopefully they can take advantage of and start teaching kids about investing for their future and investing for the money. So that's it. That's the 10 provisions so far that we've kind of gone through and been able to identify out of the One Big Beautiful Bill. I do anticipate coming out with another video as we dive into this 1,000-page monstrosity a little bit further and pulling out some additional things that taxpayers need to be aware of. We will go ahead and make a second video and get that out to everybody. Until then, hopefully you liked the video. Give us a thumbs up, and if you think it's worthy, share it with your friends and share it with your family and share it with your coworkers, making sure that we can educate as many people as possible on this bill. If you have any additional questions on this or any other tax topic, please feel free to reach out to us. You can reach us on our website at guardianaccountinggroup.com, or feel free to email at admin@guardianaccountinggroup.com. Thanks again for tuning in, and we'll see you soon.